Hey, what's up, stock compounders? Brad here. So it is that time of the week again for our weekly Q&A session. So let's jump right in without further ado. So first question I asked myself, which was kind of silly because it's not an easy question. How did you develop the arrogance to think you could outperform the market by picking individual stocks? To be fully honest here, guys, I don't know that I can outperform the market. Okay, it's part of why I'm testing a magic formula approach. Um, I'm trying to outperform the market by picking individual stocks. I think it's sensible to have a certain amount of time that I continue trying. And if I haven't done it within that period of time, it might be the best idea to just admit to myself that, all right, this isn't going to happen. I don't have whatever skills that I need in order to do this. So I need to just invest mechanically, whether that's an index fund or a group of index funds or the magic formula approach, something different. So the short answer is I don't know that I can, but I think it's worth trying. So that's what I'm doing. I'm trying. Next question, just sharing an interesting observation, so not a question, an observation, that Pabrai has increased his stake in NICE holdings in South Korea from 9% to 10%. Saw this from the annual report released in March 2021. I wish if I had access to NICE holdings in South Korea, I would be diving headfirst into that company to try to understand the investment thesis, okay? I haven't figured out how to buy in South Korea yet. So if you're able to, probably one to look at. Have you heard of the website Cheaper Than Guru? It visualizes buys and sells from the gurus, and if so, what's your opinion about it? I have not heard about it until now. So I will check that one out. Sounds intriguing, to be honest. It'd be great to be able to visualize what the gurus are buying and selling. I'm not sure what exactly that looks like, but I will take a look at that. Thank you, Robin. Henry, would you prefer to find gold nuggets, bargain stocks through your own efforts or your thorough analysis, or be a shameless cloner when you rely on piggybacking on the back of titans of investing? So that's a great question. Obviously, there's an ego. Each of us kind of comes with an ego, or it's developed by the time we're adults. And it's a strong preference of humans to kind of do original work. And I think that's part of why it's such a strong quality to be willing to shamelessly clone. Okay, Pabrai talks about that. There's a part of me that knows I have this kind of inherent bias towards doing things myself. And so I'm really trying to fold the paper back the other way by trying as hard as possible to only stick with ideas that I'm getting from others. Okay. At this point, I much prefer to find stocks by looking at what great investors have bought recently. Okay. In fact, I would go as far to say I don't want to look at ideas that other great investors don't already own, at least one great investor. I think that's a great question. I think it's worthwhile to really sense that in yourself, how you feel, how you would answer this question. Because when you get into it, when you bring ego into investing, it becomes a lot more difficult of a game to win. So I'd encourage everyone to really think about that. Would you rather own a fast food stock on margin or the physical fast food restaurant with a loan from the bank? How is the risk different? So, I'm not a great person to answer this. I don't invest on margin. And I don't have any interest in owning a physical fast food restaurant. Okay. Or really owning any kind of brick and mortar business. I don't really have any interest in that. I want to be a passive owner, okay? I want to own the stock in a business where I don't have to make all of the decisions about how that business is run. I want to find a management team that I trust to make all of those decisions much better than I would. So, again, I haven't done either of those things, so I'm really not the person to ask. But it's an interesting question. Bill, many gurus own Berkshire Hathaway, but I don't see the same interest in Fairfax Financial. I've also observed that, which I've heard you call the Berkshire of Canada, and that is not mine. That is something that I've heard from others. Are we missing this data due to it being a Canadian company, or are there other reasons? So I haven't done a deep dive on Fairfax. From kind of the few investors that I trust who have looked at Fairfax and also looked at Berkshire, they all seem to really favor Berkshire Hathaway. So, until I did a deeper dive on Fairfax, I can't really comment on this. It's possible that because it's a Canadian company, that it's just not getting nearly as much attention as a U.S. company would. I don't have much more to say about Fairfax Financial, but it would be a very interesting question to ask in corner of Berkshire and Fairfax, because obviously there's a lot of people in that forum who follow Fairfax Finance, both Berkshire and Fairfax. So I may actually ask that. That could be interesting to look at responses to that one. Jack, would you buy a company that you think is fairly valued as opposed to undervalued? Well, if I thought the company was fairly valued, I wouldn't be expecting any kind of superior returns over time, right? I don't know why I would buy a company that's fairly valued. Obviously, there are multiple ways to kind of think about what fairly valued means. But in my mind, if something is fairly valued, I don't expect to outperform the market over time, okay? Because it's fairly valued. If I think, it's fairly valued today, but it's going to grow a lot more over time, well, to me, that doesn't even really make sense to think that way, because how I see the growth over time is built in to today's valuation. So I guess the answer is no. I wouldn't buy a fairly valued company. That's kind of the framework, the mental framework for how I'm thinking about that question. Jack, if you want to ask it any differently, I can take another stab at it. Thoughts on satire? At least I think that's how it's pronounced. I believe this is an Australian company. And I think it was pitched in Twitter by, what's his name? I made a recent video on 9 investors to follow on Twitter. Jeremy Raper, I believe, is the guy on Twitter who was recently bullish on satire. I haven't dug into it. I really like to focus on U.S. companies. They tend to be easier for me to understand because I live in the U.S. There's a lot of things I understand about business in the U.S. just because I kind of live and operate here. If I'm looking at things in other markets like Australia or Japan or wherever, there's a whole nother kind of cultural customs layer to understanding businesses. I mean, Australia probably isn't so much different than US, but I haven't looked at the company yet. I've come across the website Baltini, which looks exactly the same. I'm not sure. There are a number of Aussies, Kiwis, Investing with Tom is in New Zealand. Investing with Frank is in Australia. There's a few other Australian investors that I know are also YouTubers. So I'd be curious to hear from them. But Yeah, I haven't looked at it. I'm pretty sure there's no Value Investors Club write-up. I can't see, what the gurus think of it because it's traded in Australia. And yeah, I don't think there's any functionality. It would be interesting to compile some kind of international shortlist of gurus to follow, to kind of measure up these foreign holdings, foreign to the U.S. holdings. But I haven't done that yet. If one's portfolio has a substantial margin of safety, would you say it would be a good idea to be 100% invested even in these times? I presume that even in these times means that this investor thinks, it's a bit frothy out there, at least in the U.S. markets. I don't know if this person lives in the U.S. I would say yes. I mean, if you can find great investment opportunities, which implies there's a substantial margin of safety there, I wouldn't have a problem. I wouldn't have any problem being 100% invested if you can find deals. The correlation is typically when markets get frothier, it becomes harder and harder to find compelling investment opportunities. But in any market, even the frothiest markets, there are always going to be opportunities to buy at a discount, to fair value. But in anyone's given circle of competence, there tend to be many less opportunities when markets get frothy. And I would say, we're probably at the frothy end of kind of the market cycle right now. But yeah, I have no problem with anyone being fully invested, even at the frothy end of the cycle. So whether or not it's a good idea just depends on, are you finding compelling opportunities? I tend to not play, macro, the macro picture where we are in the cycle. Certainly, I wouldn't sell a bunch of stuff just because I think it's frothy, to be hoping there's going to be a crash. I think that's an ill-advised approach to investing. I think younger investors tend to think that they're going to be able to generate outsized performance by doing that market timing. I think the more experience investors get, the more you kind of get away from that approach of thinking you're able to time the market. So, yeah, no problem with that. In a market like this, have you considered or used hedge options like stop limit orders or buying calls or puts? I have not. I don't think I've ever used a stop limit order. I've bought some calls. I've bought leaps, so kind of long-term calls. But no, I don't think about hedging in a market like this. If the market plummets, I'm happy because I can buy things cheap. If it keeps going up, I'm happy because I have a substantial stake in the markets right now. So I think that's really that's a really sound approach because you can sleep at night regardless of what happens in the markets tomorrow or next week or next month. I think that's probably an underappreciated aspect of investing, that you design your portfolio in a way that you're able to sleep at night regardless of what's coming down the pike. Frank, how do you construct your portfolio? For example, how much do you or plan to allocate to each type of investment strategy? Cloning, compounders, magic formula, indexes. Frank is working towards 70% compounders, 30% asymmetric, deep value plays. So this isn't as kind of compartmentalized as what Frank has here for how he's approaching things. I'm really just going after the compounders. I have the Magic Formula portfolio. That's really my son's kind of long-term portfolio. It's not mine. I'm looking for the compounders, okay? And I'm hoping Pabrai can really put his nose to the grindstone and find some compounders for us in markets that I can actually buy in. And not just Pabrai, obviously, but other guru investors as well. So yeah, I don't have a great answer to this one, but I really am focused on the compounders. I'd like that to be like 90% plus of my portfolio, and then doing some kind of Magic Formula experiments and maybe deep value plays on the side. Once you identify a stock, what is your process of doing research? I know you look for gurus, VIC write-ups, corner of Berkshire and Fairfax. Is there anything else besides this? Yeah, I want to understand the business, and one of the best ways to do that is to read the annual reports. Going back, looking through those annual reports, what does the CEO, what does the management team say they're going to deliver, okay, in the next year, 3 years, 5 years? And, looking through time with those annual reports, did they deliver? If they didn't deliver, did they own up to not delivering? Or did they just try to sweep it under the rug and come up with a new set of promises? So that integrity of management is super important. And of course, you want to understand the business. I mean, that's really the best way to own a company for the long term, is if you understand it. And not just understand it, are you interested in it, right? And those usually go hand in hand. But it really helps if you like the business, if you think they're providing a service to the world that's kind of makes you proud to be a business owner of that business. Those are a few thoughts there. Have someone reviewed Nice Holdings, one of Pabrai investments? It is much bigger an invested bet of Pabrai's than Shinnikin and seems to be an apex spawner. So again, Nice Holdings, I don't have access to, so I haven't looked at it yet. But like I said, if I could access it, if I could invest in it, it would be on my short list of companies to look at. What do you use Clubhouse for? So I haven't been on Clubhouse probably in a month. I haven't used it much. I like the idea of getting some kind of value investors together, maybe weekly, and just doing like an hour powwow with kind of what are our thoughts on the markets, getting questions from people who pop in. I like the atmosphere of Clubhouse. My understanding is Facebook is going to try to come up with something very similar. Twitter, it sounds like Twitter Spaces might be something similar to Clubhouse. But it's really just for kind of sharing ideas and chatting in real time with other smart people. During these times today, there's a lot of questions these times, in which the U.S. and mostly Western world is priced highly. Would you consider allocating more capital out of the portfolio towards investing techniques that ignore market conditions? For example, arbitrage opportunities, spin-offs, misunderstood holding companies, and more. Not really, because when you do that, say you find an arbitrage opportunity or a spin-off or whatever, you have to wait until that mispricing is corrected, right? That's how you make your money on that opportunity. So in a way, it ties up, at least it can, tie up your capital. And there's no reason it can't go lower before, it prices in alignment with value. So, I was doing a little stuff in SPACs for a while there. I've mostly kind of halted that. But no, I think there's really something to be said for cultivating patience in times where the markets are frothy, when you're not able to find anything compelling. I think it's just fine. It's actually encouraged, I would say, to just sit on your hands and learn how to do nothing. And what I mean by do nothing is don't buy anything. Obviously, we're constantly learning, right? We're educating ourselves. We're researching opportunities. We're expanding our circle of competence into new areas that are interesting to us. But to me, saying, okay, I can't find any compounders at compelling prices right now, so I'm going to go over here, even though it's not really where I want to be. I think that may be a mistake. So I'm trying to really just cultivate patience and really dive into, all right, what exactly am I looking for? And how will I be able to identify it when it comes along? Really just kind of honing that focus. What Pabrai, one of his 10 commandments is, thou shalt have singular focus on finding these bets that are going to return 26% per year or more. So I think that's really good advice. And spinoffs, I think spinoffs, back when Greenblatt wrote his, I think, first book, How to Be a Stock Market Genius, I think spinoffs, because of technology, because of how easy it is for people to run screens, I don't think there's nearly as much opportunity in spinoffs as there used to be in the 80s and 90s. I'm sure there's always going to be some opportunity, but I'm not convinced that looking at that kind of bucket of spinoffs is necessarily going to be a great use of time at this point. And Pabrai, that was part of the free lunch portfolio, was the spinoff bucket. He totally obliterated that. Now it's spawners. Okay, so that's an indication right there. How can a non-professional individual investor safely, in your opinion, invest in a foreign market and still maintain the same level of understanding of the business, the surrounding business environment, and all new events taking place that might impact the business? I refer mainly to markets that are out of consensus today. So what Pabrai does, which I think is smart, he has friends, investor friends all over the world, okay? And if he wants to invest in a market that he's never invested in before, whether it's Turkey or South Korea or Japan, he'll find one of these great value investors in these markets, and he'll say, hey, what have you invested in? Let's go on a tour, right? Let's visit these businesses. And I think that's smart. I think if it's in a different country where you're not familiar with the customs, the kind of laws governing businesses, governing corporations, it's much more important to kick the tires, to kind of see on the ground what's happening. And I mean, the SEC, right? The Securities and Exchange Commission in the U.S. is, one of the best in the world, perhaps the best in the world, at making sure these public companies, there's not fraud happening in these public companies that, investors like us can invest in. If you get into emerging markets, it's a totally different ballgame. Okay, you don't have the SEC looking after you. So it's tough. I don't know that it's possible to get the same level of understanding of the business. But the way that Pabrai does it is he needs to visit. He needs to know that another smart investor that kind of has his similar framework for investing has already, done a lot of due diligence on that company. So, that's one approach. But, on the other hand, because it's in one of these markets that are out of favor, you may just find opportunities that are cheap enough to offset the uncertainty, right? Not having quite as much understanding about the business. Okay? And I think that's a that's a fair trade-off if you have a high enough margin of safety. What do you think of Greenblatt's new ETF, Gotham Enhanced 500 ETF? So I don't know if this is the same one as the one I covered a few videos ago about, was it Take 5, something like that? I talked about Greenblatt's kind of automated investing approach, investing $5 or more a day. I don't know. It hasn't beaten the S&P 500 since inception. I think, what was that, like 5 years ago or something? It's hard to say. To me, what I'd really be looking at is what are the fees, and do I think, the superior structure of it, whether it's kind of trying to pick which are the deepest value plays within the S&P 500 and ranking those. You gotta weigh that. What is the likelihood that strategy is going to outperform when you consider those additional fees that you're paying, where you can buy the S&P 500 for like 3 basis points? Okay, is 50 basis points going to be worth, that trade-off? So that's how I would think about that. But I haven't bought ETFs. So again, I'm probably not the right person to ask. Have you made an investment in Shinnikin? Yes, I've made a few videos about Shinnikin. One where I actually walked through buying Shinnikin in Interactive Brokers, which is the broker that I used to buy in Japan. So yes, I've made a small investment in Shinnikin. Still weighing whether or not to keep, to double down or keep going on that Shinnikin investment. Any thoughts on the margin calls made to Archegos capital management that triggered some big sell-offs due to total return swaps? Maybe we see more instances like this to come and rattle the markets. Seems like just another add-on to the textbook example of a possible bubble. Yeah, I haven't dug too deeply into what happened with Archegos. I listened to this podcast, the All In podcast. Their last pod was, they talked a little bit about Archegos and how, there was some similarities with long-term capital management, just the ability to leverage up, very, very high multiples of the capital base. It's, I'm not really looking at it as a sign of a bubble. I don't know how isolated it is. Maybe it's more widespread and we should be concerned. But it hasn't changed my approach to investing. I'm really just looking for individual businesses that I understand that are going to be long-term compounders that I can buy probably slightly below what I think they're worth today. I don't have too many thoughts about Archegos. Pretty interesting, though. It's worth diving into that just to get a sense of how all these things work, impact the markets. I mean, what was it? Viacom and Discovery, I think, went down pretty big as a result of this company needing to liquidate. So, you guys, I mean, the market, it's fragile. I see it as fragile anyway. So, that's something to understand. It really is. And make sure your process of investing considers all of that, and that you're not going to get rattled into doing anything silly when things like this happen. Okay, because they're always going to be happening. People are always going to find ways to stretch the rules as far as they possibly can, going to get away with as much as they can, and that's just part of the reality of investing. Buffett and Pabrai always talk about not selling, but they take annual performance fees. Does that mean they sell stock at the end of the year to pay themselves, or how does that work? So that's a great question. I've never thought about the actual mechanism for how they pay themselves. I guess they must sell some. I don't know. That would be a question for Buffett and Pabrai, or anyone else who has a similar kind of fund structure. I haven't run a fund, so, but it was interesting. It got me kind of thinking, I wonder how that does work. What do you think about Pershing Square Holdings? It's trading at a nice discount to NAV, but some of the companies in the fund look expensive. Pershing Square is one kind of on my short list of companies to dig into. I believe it's traded through the London exchange, and I'm pretty sure you can't buy it on Robinhood. And on one hand, it's like, well, who cares? But on the other hand, that impacts. I don't know to what extent it impacts. The volatility of the company, both to the upside and to the downside. And as a long-term investor, I kind of like volatility because it allows me to buy kind of lower than what might be considered reasonable, and same on the sell side. So, that's kind of a small strike against Pershing Square that I have, that it's not kind of readily available through Robinhood or some of the other newer brokerages. It may still be trading at a discount to NAV. I know look at the chart. It's done fantastic in the last year. So I don't know how much of a discount it's trading to NAV. There's another piece around Bill Ackman. I'm not quite sure how much I trust Bill Ackman, how much I want my wagon to be hitched to Bill Ackman. I'm perfectly happy to let Bill Ackman be my investment analyst and look at what he's buying. But do I want to actually give my money to Bill Ackman to manage? I'm not sold on that concept yet. But Pershing Square, it is interesting as a holding company. What's your Alibaba buy price? Can you explain the goal of Magic Formula and your strategy? Alibaba, I'm really going to start getting interested. Kind of itchy buy fingers around $215, somewhere in there, $215 per share. Goal of the Magic Formula. A big part of why I started the Magic Formula test portfolio is it's really, I couldn't figure out how to accurately kind of back test the Magic Formula. So because of that, and I have this sense that there's something to it. There's something to the Magic Formula. And I believe that the tweaks I'm making, the filters that I've applied on top of the Magic Formula, are going to improve the performance versus randomly picking Magic Formula stocks. And so I'm testing it, right? I want to see if it works. I want to see what kind of returns it generates over 5 years, 10 years. And if it does well, if it does better than I'm doing, picking individual stocks, you guys, honestly, I'm happy to hang my hat up and say, all right, let's just do this Magic Formula approach, because, I don't have ego in this. I want to make money, okay? I want to achieve my financial goals, right? I want to make it to the promised land, financial freedom. And so, if the best way to do that is to mechanically invest in the Magic Formula kind of stock basket, or pick individual stocks from the Magic Formula, I have no problem with that. I'm not married to being a stock picker. So that's really why I'm doing that, to test, all right, what's my best way forward in terms of investing. I think that you should look into A2 Milk Company. I know Investing with Tom has done some videos about that. And I think this person, Rasmus, thinks it's reached a fair price. The company has had some struggles due to COVID lockdowns and is now trading at 20 times trough earnings with a long runway for growth. The company can achieve this by being nothing more than a branding company. This makes incredibly asset-light business. So I haven't looked into A2 Milk. Again, I'm primarily focused on U.S. companies, just because I live here, and it's gonna be easiest for me to understand companies where I live. But it may be worth looking at this company. I'd need to see something that really is like a clunk over the head, like, okay, this is so obvious. If you don't look at this, you're an idiot. And I haven't seen that yet with A2 Milk. And I'm also really trying to limit my investments to companies that I either spend money on, right? Like Costco, Amazon, things like that. Companies that I use somehow, whether I buy products from them or, services from them. I find myself gravitating more and more towards that situation. Because that gives me real insights into a company when I'm the customer. I kind of look at it from multiple angles. I think that can really help fill out the investment thesis and not miss critical pieces of information. And I don't drink A2 Milk, so there's something to be said for that. What are your thoughts on metal mining companies? They seem to make up a large amount of the acquirer's multiple screener at the moment. Kirkland Lake Gold is one to look at. Acquires multiple of 6.57. That's decent. Median 10-year return on invested capital around 15%. Low amount of debt. Has a recent write-up on VIC and one guru owning it. Metal mining companies. I took a small position in Lithium Americas Corp. This is something, I'll take a look at it. I'll take a look at the Value Investors Club write-up and see what I think. Another company or, investment fund I like to follow for mining companies is a Massif Capital, MASSIF. They do a lot in mining, and they seem to be pretty thoughtful guys when it comes to valuation. So recommend checking them out. And every quarter, you can read their letter to investors. It's open. They don't necessarily share all of their positions in each, probably all positions that they're still buying into. They're not necessarily going to disclose, but I'll take a look at this one. What is the maximum percentage of your total net worth you ever allocated in a single stock? Would you be comfortable with more than 30% in one position if you are confident in the investment theory? Probably around 20% is the max I've ever allocated to a single stock. In terms of would I spend 30% kind of cost basis? Probably not. I'd certainly let it grow. To 50, 75% of the portfolio, maybe more. But I wouldn't put down more than 30% of the portfolio in one position. Simply because, no matter how bullish I am on a company, I have blind spots, right? And, maybe a third of the time, I'm going to be wrong on my thesis. So, if I put 30% of my capital into a company, and that's the 1 in 3 that I'm wrong on, that's really going to hurt. Okay. I saw a tweet recently. It was something like, you want to put enough capital into a stock where, if it crushes over the next decade or more, you feel it in the portfolio. It has a real impact on the portfolio, but you don't want to put too much that if it tanks, it's really going to hurt. Okay. So it's kind of riding that line in terms of how much capital I'm allocating in each position. And 30% feels a little bit high for me. I'm more comfortable around 20%. That's where I'm at now. May change. Maybe I'll go 33%, 3 positions. Who knows? But right now I'm kind of at I'm wanting 5 high conviction bets at around 20% each. So anyway, guys, thank you all for the fantastic questions. And yeah, I keep promising you guys, my wish list, my stock wish list. I will get that to you this week. Okay. And it's not going to be as large as my last wish list. I think I had like 10 or 12 companies on my last wish list. This one is going to be smaller. Okay. And that's just kind of how I'm moving as an investor. I want fewer ideas, which allows me to understand those fewer ideas better. And kind of make those higher conviction bets. So that's just how things are trending for me. All right, guys, that's all I've got for today. I will see you all in the next video. Take care.